Okay, so welcome you all once again to this session. We're going to look at for a summary section of capital budgeting. Summary section of capital budgeting, or what known as what? Investment appraisal. Good. That is today's section. Okay, so let's go straight to the point. Now, when you talk about capital budgeting or the investment appraisal, they do have relationship. You know, in summary, we will say that before any project will be budgeted for in the annual budgets, it needs to be what? Appraised. So we should take note of that. We need to just evaluate on financial grounds whether or not the project will be good or successful. When you talk about capital budgeting, it's a special type of budget that deals with long-term projects or capital projects. So it deals with appraising or budgeting of what? Capital projects. Capital projects. That is the capital budget. Okay. So projects that have a long-term prospect. Before you budget for, or before you include such projects in your budget, make sure that you have what? Properly appraised that project. And capital project can also be referred to as what? Investment. So if we are budgeting for an investment, then we need to appraise it first. So this leads to a particular topic or section, a subsection called investment appraisal. That is what we are going to look at for. Investment appraisal. How to appraise a project. That is all. Before I move on with the game, let's look at some differences between capital projects and revenue projects, or capital expenditure and revenue expenditure. Let's look at them. So, summary point. We are going to appraise a capital project, so we should know the composition of what? Capital projects. So let's draw some table in here. Let's write here capital. Let's write here revenue expenditure. Revenue expenditure. Okay, so here what you have to do is tell me the difference between capital. Because a distinction, a clear distinction needs to be made between capital and revenue expenditure. Here, they are expenditure to acquired assets, expenditure towards acquired assets. Acquired assets. These are expenditure to run the business on daily basis. Expenditure to run the business on daily basis. Expenditure incurred to run the business on daily basis. On daily basis. I will get it right. Again, it can also mean that expenditure incurred to improve existing assets like modification, expansion of an asset, replacement of an asset. So just a mere improvement, expenditure incurred to improve the assets. Then revenue expenditure to just maintain the economic benefit, so normally improve the assets. To improve the assets. Either you are buying new assets, good, acquiring assets. Expenditure incurred to acquire assets, or expenditure incurred to improve existing assets. To improve existing assets, let's improve existing assets. That's all. Improve existing assets. To existing assets. What about the revenue? Revenue to just maintain the economic benefit, just for maintain. So if you incur revenue expenditure on existing assets, it means that you are just maintaining the economic benefit. To just maintain the economic benefits. So that is all. Okay. And I'll give examples. Let's give specific examples. So number one, acquisition of assets. Acquisition of what? Non-current asset, fixed asset. Non-current assets. So acquisition of non-current assets. Good. That's the first example. Acquisition of non-current assets. Example two. Entering into new business. Entering into a new business. The final one is replacement of assets. Replacement of what? Assets. Replacement of assets. And improvement. Replacement of assets and then improvement. Replacement of assets and improvement. These are the examples of what? Capital expenditure. What about revenue expenditure examples? So examples. Number one, we are acquiring non-current assets. Okay. So here we are just spending on operating expenses, so operating costs. Operating expenses, they are what? Revenue expenditure. All the operating expenses, they are revenue expenditure. Then number two, here we are entering into new business. It can also be that with the revenue expenditure, we are just maintaining the business or the operating costs. Operating costs, so it's still the same here. Replacement of the assets. Here we are just repairing or maintaining the assets. Repairs to assets, so repairs. All the repair costs, except for if it's amount to what? Replacement of major components or parts. Let's add one more distinguished factor to it. The next one will be the duration or the benefit. With that of the capital expenditure, the benefit will last for more than one financial year. But for that of revenue, the benefit lasts within what? One financial year. So take note of that. Okay, so basically that is that. Now let's go to the capital budgeting process. capital budgeting process. Now that you know the difference, now let me be a bit straightforward. For the purpose of the examination, most of the investment appraisal person will be centered on either you are buying acquisition of non-current assets, buying new assets, or entering into new business. So take notes, most of your question will be either on acquisition of new non-current assets or entering into new business. So take note of that. Okay. Now let's move on to capital budgeting process. The capital budgeting process. Capital budgeting process. Or the investment appraisal process. Investment appraisal process. Investment appraisal process, or the steps. The steps in investment appraisal. What are the steps? Let's see the steps. We are saying that before you budget for any capital expenditure, make sure that you have what appraised such expenditure or such investment and see their financial disability or acceptance. So financial acceptance level or disability. You need to go through some few steps to get it done. Step one. So the steps in investment appraisal or capital budgeting. So the steps in investment appraisal. So steps number one. Now generate investment proposal which in line with the company's strategic objective. That's the first step. Generate what? Capital investment proposals. So write the proposal. So capital investment proposal. That's the first step. But make sure that it's in line. So which is in line with the company's objective, with the company's strategic objective, like it's formed within the target of the organization. Take notes, no shortcut items. Okay, so before you budget for any capital expenditure, make sure that that capital expenditure is in line with the company's expectation and company's strategy or strategic objective. Because what is not in a company's objective or strategy, you find it difficult to accomplish it because it will lack what you call feasibility. Yes, because what if not prepare your mind for, you cannot probably accumulate it. Yes. Okay, that's the first step. That is all. Generate a proposal. Tell us what you want to go in for. Go further to tell us some features, benefit, good news, and that is all. The proposal. So management want to fix a new equipment. So you have to first of all write a proposal for approval. That's the first stage. Now let's go to the second stage of the process. After the proposal after the proposal has been accepted by those charged with governance or the authority, good, what is the next step? Then step 2, you now forecast cash flows or the relevant cash flows about the project or relating to the project. So the step 2 is that tell the examiner that we have to forecasting relevant cash flow. We didn't say just that cash flow, relevant cash flows relating to the project. Relating to the project. That's the second stage. Tell us the likely cost that you incur if you buy this asset. Tell us the likely revenue that you may earn when you buy this asset. Put all of them together, find your net, and then we move on from there. So just generate cash flows. It's full of estimation. That's why I use the word forecasting. So that is it. Now let's go to the step 3. That is where your section comes in. Step 3, evaluate the project. So step 3 is evaluating the project. As a step 3, evaluating the project. Can you look at these steps carefully? 2019 May, one of the professional body asked this for 10 solid marks. Yes, so kindly follow the steps carefully. Now, evaluating the project, that is the third step. So, evaluating the project. So, step 2, after a successful forecasting of the cash flows, which is the step 2. So step 2, forecast the cash flows. Tell us the estimate of revenues or cash inflows, payments, or the cash outflows that you are likely to earn or pay. So that was the step 2. So after you have generated details, cash flows about the project or relating to the project, now move further and come to step 3, which is evaluate the project. Now use the information gathered in step 2, the relevant cash flows you've gathered so far in step 2. Use that relevant cash flows to evaluate this project and see whether financially it sounds good. So that is the evaluation, and this is where the appraiser comes in. This is where the appraiser comes in, and this is where we need a lot of techniques. Yes, this is where we need the techniques. Now let's go to step 4. So after evaluating the project, you successfully select one of the projects, or you will make a decision whether to go forward. So after the evaluation, you probably arrive at the final conclusion whether you should move ahead with the project or withdraw based on the effect or the final solution or the final destination of the evaluation process. If probably after evaluation, they are not telling us good news about the project, what do? We just have to abandon such projects. So take notes, that's the step 3. So right after evaluation and you selected the successful one, step 4 was implementation. Implementing the project, so implementation of the project. Selected. So implementing projects which satisfy the company's criteria. So your decision, the objective, the reason behind the acquisition, make sure that you selected that one as a basis. Now, what do you think after implementation? What will be the next step? After you have successfully evaluated the project, you've implemented it, it's going on, you are receiving some money inflow, some outflow. What's the next procedure? Okay, so basically, right after implementation, then you need to monitor the progress of the projects. So we will say that monitoring the performance of the investment project. So step 5, that is that you have to monitor. So monitoring of monitoring the performance of the project. Now, this section is very critical to ensure that the project perform in line with expectation. So monitor it and be sure that the stated amount has been included. So be sure. That is all what we are talking about. So basically, that is that. These are the stages that we go through. Now, we mentioned that you have to evaluate the projects. And we have what you call the assessment. The project needs to be assessed and evaluated against a general rule. Can you take this general rule? I've not seen questions on that, but in the modern era, questions need to be asked on this general rule. So I'll just pick the implementation. Sorry, the evaluation of the capital project. On what basis do you select the capital project? What are the general rules? The general acceptance criteria. Third examiner, that we are going to assess. We are going to assess and evaluate the projects based on the following criteria. Based on the following criteria. So only 2. Risks and return. That is all. That examiner. That we will appraise the project based on what? Risks and return. If the risk is what? Acceptable, I will accept the project. If the risk is okay, if the risk is between the relevant range, if the risk is within the acceptable criteria, oh, let's go in for the project. If the risk, sorry, if the return is what? Suitable return, handsome return, it's okay, suitable. That is all. So if you are appraising a project, these are the criteria that we are going to use to assess projects. Even though we have specific ones, but I believe this is the general. Okay. So that is that. Now I want to throw a little light on the last stage of the capital investment appraisal steps. We say monitoring, right? But the last stage is monitoring. Yeah. Good. Monitoring and what? Control. Good. Make sure that your expectations are in line with that of the actual. This section is very critical. Normally, people invest and leave the investment idle. At the maturity date, before the realize that they are not getting the right return or the expected return. When happening that way, they become a bit disappointed. I'll give you a critical example, like in the case of men's growth in Ghana here. If you deposit your funds in these Ponzi schemes, all what you have to do is just monitor. Anytime there's little variation, you take a critical decision. Don't leave your investment idle. In fact, even farming, if you plant the seed, you have to continue what? Probably monitor the stages. The same thing happens to an investment. Don't just invest in and say, oh, allow the investment to run, which I'm on my way. No. Monitor the project to see if year one, you said that you must get, let's say, 30,000 as your cash flow, net cash flow. At the end of the year one, assess and see whether this 30,000 you're able to achieve it. Then you move on. If not, take a critical decision and then you are done. Okay, so we are done with the steps. Now, let me go to the final one, then I'll now go straight to the main point. The final one that I will probably talk about is the features of investments or capital budgeting or investment appraiser. You know, this investment appraiser, it's involving forecasting of cash flows. Yeah, this is the feature. You have to forecast cash flow. You have to look at the decision. It's involving using a lot of techniques connected to calculate it. Okay, so that is that. Now let's go straight to the game. Let's go straight to the game. Now let's look at the investment appraiser techniques, the basic ones at the basic level. Investment appraiser techniques. So let's start. Investment, but after to top investment appraiser techniques or methods. So investment appraiser methods. Okay. We have basic methods. Basic methods here. One. First one, we'll talk about accounting rate of return. Accounting rate of return. Probably known as what? ARR. So call him his nickname. ARR. Accounting rate of what? Return. Method number two, payback period. Yeah. Payback period. We still call it okay. Now number three, very important. We call it number three is like a cluster of methods put together. We put the remaining methods under one section. We call them discounted discounted cash flow techniques. Cash flow techniques. Discounted cash flow techniques. Cash flow techniques or methods. There are cash flow techniques or methods. Now over here, we'll talk about few ones, even though there are many. We talk about only three of the discounted cash flow techniques. That's the one that we'll talk about. And take note of them. Kindly take notes of them. The first one is called adjusted or discounted payback period. Payback. Either adjusted or discounted. So that means there are three types of payback, right? The normal payback and the one that we discount the cash flows. Then we have what you call almighty net present value, NPV, net present value. Then we move on to almighty internal rate of return. Internal rate of what? Return. Now, let me now form under this. We have modified rate of return. We have APV, but there are more, but we are going to limit ourselves to this per our syllabus to this. Okay, so that is it. Now, have you seen these ones, the discounted cash flow techniques? Yes, these people, they are in to solve a particular problem. The first two exhibit a key challenge, and then the solution is that we need to introduce discounting. So that's why we have discounted cash flow techniques. So kindly take notes that the discounted cash flow techniques, they are in to solve a major challenge of the first two. The discounted cash flow, the first two don't discount the cash flows, and it poses a lot of challenge. Yes, it does not make the analysis accurate because time value of money probably is very important. 1,000 cedis in 2 years' time might not be the same as 1,000 cedis today. It's today that you are assessing or you are estimating or forecasting the cash flows for future periods. So take note that the present value or the cash flows with these two methods does not present value any cash flow or any of the item, which indeed pose some challenge. Now, this is how we are going to do it. Today, for instance, we are going to look at account rate of return and then payback period to just clear the show. And next meeting, I'll look for, but I'll do three. One, two, three today. Now, next meeting, I'll look for these two, and then we move on to the next section. Take note, last thing, one of the professional body, that is ICA Ghana, they had a question on internal rate of return, which we also call it the break-even rate. So that is it. Now let's start with accounting rate of return. Accounting rate of return. In fact, if you pick any of the methods and you are talking about them, please make sure that you know about 4 items about this. So when I pick any of the method, number 1, you should know the principle, know what it talks about, you know the meaning, but they can ask you to explain. Number 2, you know the advantages and disadvantages of this method. Number 3, you know the acceptance criteria. Acceptance criteria, meaning that on what basis do you select projects based on this method? And number 4, which combine everything, it combines these two together. That's the features and ways that it can be improved. That is all. So, first, I like 1 item in meaning and the calculation has been calculated. And calculation, add calculation to it. Good, meaning and then the calculations. Take note. When asking questions, we cannot move outside this. That is so. Either we are asking you to calculate for us, or we are asking you to explain. We are asking you to give us the challenges or the good news about this method. So take note of that. So let's start from accounting rate of return. So I'll go through like this and then we move on. Like I said, make sure that before we finish everything, all the methods, you know this about them. If you don't know this about them, don't register the people. Okay. Okay, so let's start. Meaning, calculation, advantages, acceptance, features. Put them together. Now, when you pick the accounting rate of return, as the name suggests, accounting rate of return. This method uses the accounting profit that will be generated from the project. So tell the examiner that here the project will be assessed based on the accounting profit. Tell the examiner. That is all. That is why we call it accounting rate of return. It uses accounting profit. We measure projects based on the accounting profit. Okay, basically, that is that. Now let's go straight to the formula. Yeah, the formulas are 2. A good examiner will tell you which one to use. So now, being informed, select the best one or the first formula. So formula number 1, accounting rate of return, ARR for short, is nothing by average accounting profit, not taxman's profit, accounting profit, all divided by average investment. All of these multiplying by 100 because it's rate. The answer is in percentages. So multiply by 100 rate, 20%, 18%, 12%. And so that is the formula 1. Formula 2, tell the examiner that accounting rate of return is nothing by still average profit, average accounting profit, all divided by initial investment. Initial investment. Again, times 100. Yes. So these are the 2 methods for investment appraisal. Sorry, for that of the accounting rate of return. two methods. A good examiner will tell you which one to use. If not, if they don't tell you, that doesn't mean that they're not good though. And again, if they don't tell you, kindly select the best one and make it clear to the examiner. So you don't hide anything from the examiner. Yes, make it clear. That Mr. Examiner, I am using average method, the average investment. One day with average investment, one day with initial investment. That is all. That's the difference. So be clear and be specific. Don't hide. You should, or you do the two. You should take the best one. No. In exams, students are not allowed to test the examiner, to ask the examiner questions. No. It's the examiner which is on the floor asking questions. So take note of that. Okay, now let's go further. How do you find average profit and average investment? That is also formula number C and then D. C and D will provide meaning and interpretation to this, because I have to tell you the composition of average profit, right? And average investment. That is all. Initial investment, I don't need to provide a formula. There's no formula for initial investment. Initial investment is like what you are probably investing the capital sum of money that you need to pump into the business. Let's see here. Let's provide extra notes. So notes. I'll go to C and continue. Formula C, I'll talk about average accounting profit. Is equal to an examiner that is equal to total accounting profit. Total accounting profit, all divided by number of years or the project life, useful life of the project. So the project life or useful life. Good. Now, the accounting profit, please, we want the controllable profits. Basically, we want what? Controllable profit. So take note of the accounting profit. We want the controllable profit. Where controllable profit means the profit, the operating profit. Yes, the operating profit. Good. So it must be after depreciation. After what? Depreciation. So take note. The profit must be after depreciation, but it must be the operating profit afterwards depreciation. So if depreciation have not been deducted, go ahead and deduct the depreciation. Take note, we mentioned profit, we did not mention cash. We mentioned profit, and cash and profit are two different things altogether. They are not the same. Cash and profit, they are not the same. Unless you tell me cash profit. Have you seen cash profit? Yeah, it's a profit at the same time cash. Good. Okay, so that is that. Now let's do something here. Here you just have to add all the profit that need to be, or the profits that are likely generated from the projects. Then you add all the profit together. You know how to get accounting profit, right? Sales minus what? Sales minus the variable cost. You get contribution minus the fixed cost, minus the operation cost. Then that's the normal way of determining accounting profit. That is all. Okay. Now let's go to formula number C. That is the average investment. So that's D, sorry. Average investment. Average investment. Average investment. The first formula have average investment, which is equal to the initial investment plus the scrap value. plus the scrap value all divided by what? 2. That is the initial average investment. If there is working capital, please don't forget to add it. Plus what? Working capital. The final answer here plus working capital. We will meet working capital at the investment appraisal section, MPV. So when I reach there, I'll explain working capital to you in detail. Okay. So I think now we've explained the formulas. Initial investment plus the scrap value all divided by 2. And then finally you add your working capital to it. And then we add that. Okay, so basically that is that. Now let's see. Now let's look at this. So I'm going to pick an illustration and then we move on with it. But before that, let me be a bit clear here. We said we want profit. The profit is an aligned word. So let me mention this. When we give you cash flow is not the same as what? Profit. So kindly convert the cash flow into what? Into profit. How do you convert cash flow into profit? You convert cash flow, if the cash is, let's say, 70,000, then calculate your depreciation and less the depreciation from it. That is all. So profit is equal to cash flow minus what? The non-cash item or the depreciation. The major non-cash item is the depreciation. So when they give you the cash flow and they ask you to calculate accounting rate of return, it's okay. Just pick the cash flow, calculate your depreciation, add them back, and then you will get the accounting rate of return. Okay. Okay, so let's see. Let's pick our first illustration. Our first illustration. Let's use example 2 in the material. Even though the question is for payback, I'm going to solve it using what? Accounting rate of return. Let's adopt for accounting rate of return. So should the investment be accepted? After the calculation, we look at the acceptance criteria and then the advantages and disadvantages of this. So I'm just taking the data here to just calculate the accounting rate of return using the first formula, the average. Okay. So let's see. It said target publication is considering a new project requiring a capital outlay of 140,000 on equipment, an investment of 20,000 working capital. The project will have a 4-year life with an estimated residual value of 5,000. The project is expected to end the following net cash receipts. The examiner has given us what? Cash receipts. But for that of account rate of we're interested in what? Profit, not cash. So they're giving me cash. I have to maneuver my way to probably convert this cash into what? Profit. How do you do that? It means that it's not subtracted what? The non-cash item, which is the depreciation and co. So you have to let it from it. So just have to calculate depreciation. Now let's see. I'll solve this question in 2 foot. One long approach, 2 the short approach. Then you select one. Then that is all. Okay. So third examiner, solution. We are calculating accounting rate of return, ARR. First, they have given us a cash flow. So the table should be like this. Yeah. Example 2. So I'll put a year here, drawing 9 table. In that table, I will have a year. Then I will have the cash flow given to me. I'll calculate my depreciation and that's what you call accounting profit. That is all. So that's how the table look like. So first, let's see. Let us examine net cash flow. They say net what? Cash flow. Let us examine my depreciation. Let us examine my profit, because accounting rate of return, we are not interested in cash. But the word accounting is not about cash. The word accounting is about profits. It's about records. Good. So that is it. Accountants, we are interested in what? Profit, right? Maximize the shareholders' value. Year 1, year 2, year 3, year 4. Don't forget that accounting of the result year 1, year 2, up to year 3, up to the final year. Let's go and record the cash, what they've given us. So let's see. Cash year 1 is 90, 48, 90, 25. So 90, 48, 90, 25. Good. So these are the cash flows, net cash flows. All what we have to do is we have to calculate depreciation. If they don't tell you, just let a straight line and move on fast. They don't tell you the method that we should use to calculate the depreciation. Kindly use your straight line. Don't cause trouble for yourself and use reducing balance. Or the other method, please, we are begging you. Don't have the whole day to write the exams. Only have 3 hours. So allow, even if you are the owner or master of what reducing balance, unless you are being asked to use it. And I'm highly certain that at this level we are not testing you how to calculate depreciation. So we don't bring those stats in. Like the method strictly, if you want to tell you, we tell the company's policy to depreciate all non-current assets on what? Straight line basis, and then we move on. So the same way, when we give you the chance, select the best method or straightforward one. Don't cost trouble for yourself in exams. Okay. So that is it. So let's go to the question and let's go and calculate our depreciation. Asset was acquired for 140,000, right? 140,000. Okay. So can you calculate the depreciation for me? And let's see, can we calculate the depreciation and then let's. Depreciation is just the cost of the asset, 140,000, less the scrap value of 5,000. And then what do? We divide by our number of years, the project life. What's the project life? 4 years. Okay. So in short, our depreciation will be something like 140,000. So that is on the depreciation weapons minus 5,000 divided by 4 years, and this will give us 33,000 . 750. Okay. So it means that over here we need to take off 33,750 from each of the years. 33,750. 33,750. 33,750. Kindly put it in bracket. That suggests that we are subtracting. What is the profit at each level? The first one, 90 minus 33,750. Any answer? Okay, so 90 minus 33,750. Okay, so get 56,250 for the first one. Okay, so 14,250. And then again 56,250. Again, negative, right? Yeah, negative 8,750. Good. Now sum all of them together. Sum all of them together. What's the total profit? Total profit. So 56,250 plus 56,250 plus 14,750. Okay, so this and this give us this and this is 500. Okay, so this and this cancel, right? Yeah, it's cancel. So 56,000 plus 56,000, that's 112,000. So that's 8,000 will give us 104,000 plus 14,000, that's 118,000, right? 118,000. Perfect. So 118,000. Let's examine the average. Average would be into bracket 118,000. We say average is equal to total profit divided by what? The number of years. We are looking for the average profit. This is the total profit, 118,000. Then we proceed to look for what you call the average profit. How do you get average profit? You said it's the total profit of the 118,000 divided by the project life, the number of years. Yeah, the project life is what? 4 years. Okay, so the average profit is 29,500. Okay, so this approach is very lengthy. How to arrive at this average profit? This section is very lengthy. You can go through a shortcut. The shortcut is that to get it, just add the profit, the cash flows together, right? So the total cash flow. So I'll do the alternative method or method 2. Okay, so the alternative approach will be like the method 2. Just get a total cash flow. Total cash flow. Where is it equal to? So let's pick the calculator. Sum up all the total cash flow. So 253,000. So total cash flow TC 250. So 253,000 is the total cash flow. Tell the examiner, less total depreciation. Less what? Total depreciation. Total depreciation is nothing but, we call it depreciable amount. Depreciable amount. Amount that will suffer for depreciation. Yeah, don't even worry yourself to even calculate it. Less total depreciation. Don't worry yourself to calculate depreciation for a year and multiply by what? 4 years. No, don't do that. It's a long process. Depreciable amount is an amount, part of the asset that will suffer depreciation. If you have an asset, a mobile phone, and this phone, the cost is, let's say, $1,200 or 1,200 cedis. Let's say $1,200, but 1,200 cedis. And this phone, after you have used it for, let's say, 5 solid years, you can sell it for 200 cedis. Which part of this cost will suffer depreciation in your hands? That means in your hands, you use it for 1,000 and sell it for 200. This 200 will not suffer for depreciation. So that is why when you're calculating depreciation, there is the cost less the scrap value or the residual value. The residual value will not suffer for depreciation. So it will not be depreciated. That's why we take it off, right? So if we take it off, let it what? 1,000. And that 1,000, we call it depreciable amount. Depreciable amount is an amount that will suffer for depreciation. So here, just the total depreciation is the same as what? Depreciable amount. So in short, just take the cost less what? The scrap value. That is all. That will give you the total depreciation. So the alternative approach will be, open a bracket, tell the examiner, total cost of the asset is 140,000 less 5,000, right? More here, at 140 less 5,000, no shortcut. 135,000, right? Yeah. Now let's less it. So 253,000 less 105. So this one gives us 118,000. Then we now tell the examiner number of years, project life is 4 years. So therefore, average will be the same 29,500. So this is a shortcut, this is a long approach. Kindly select one or have the two with you. Okay. Perfect. Now what happened is this. So it means that even I can just list it like this, eh? Get the total over here to be 253,000 and get the total depreciation, take it off and continue like that. Okay. So now we're able to determine the average was profit. Now let's go to average investments. I'm going to dash this section and go to average investment. So let's take note. Okay, so what we do is this. Sorry. Let me continue from this section. So the next item that we have to calculate is what? The average investment. So let's see average investment as the next one. That examiner is equal to the initial investment, which is 140,000, plus the scrap value, 5,000, or divided by what? 2. If there's any working capital, kindly add it. If there's any working capital, kindly add it. Let's see this receive there's working capital in it. There's working capital of 20,000. So working capital of 20,000. It is not always the case where they'll give you working capital. So if it's not there, don't worry yourself. Just move on. So 20,000, right? So this will give us 145,000. So that is 72,500. So 72,500 plus 20,000, right? That should give us 92,500. That is the average investment. How we get that? Okay. Now what happened is this. The next line becomes the accounting rate of return, which is now equal to average profit of 29,500 over average what? Over average investment of 92,500 times 100. What is the accounting rate of return? So basically, this gives us 31.89%. Basically, that is the answer that we will get. Okay, so now let's move on to the acceptance criteria. So this 31, do you have to accept it or reject it? There's a particular way that we accept projects and are using accounting rates of return. So that examiner, that acceptance criteria, or we also call it decision rule. On what basis do you select a project using accounting rate of return? So let's look at that one. First, every company have a target ROCE or a target rate. So either you compare with the two items. Compare with the following two items and select the higher. Or select it if it is higher than the following two items. Number one is target return. Every company have an expected return. So target return or rate of return. Before you enter into any project, you have expectation. This project must give me 40% too. Your target is 40%. And if calculate you are getting 31, you go in for it? No. I'll go in if this account rate of return is what? Higher than the target return or the expected return. Or number two, if it's higher than what? The ROCE, return on capital employed. Return that you've employed. So the issue is this, the capital that you've employed, what is the return on it? The ROCE. So I'll give a trial where kindly go and tell me the difference between ROCE, return on capital employed, and accounting rate of return. Tell me the difference. Very unfortunate that all these assignments have not received one, not even one. So I know for sure that history will always repeat itself. What happened 2018 November might happen again. One of these assignments with their life encouraged. Yes. So that is that. I'll pray hard and then I'll work things so that at least one of these assignments you might see there. Yes, to encourage those who work on the assignments. So try difference, they are difference. Okay, so that is the end of the game. So here, if the target ROCE is, let's say, 30%, expectation is 30%, should they accept it? Yes, they have to accept it. Here, their target is 30% or the ROCE is 30%. Now, by here they are getting what? 31. It's more than the ROCE or the target. That is all. The reason is this. return on capital employed. The funds that the company is using, the money that we are using, we are paying our provider of finance, those that brought the money, 30% on every 100 Ghana that they've invested. Okay, fine. So if we are going to use this money to finance a project, then that project should pay us more than what the holders are requesting. Because if the holders are requesting for, let's say, 40%, then we cannot pay them. Because this project is giving us 31. It's not even enough. It's not even enough. So that's why we have to reject it on this ground. Now let's go to the advantages and disadvantages and run away and give advantages and disadvantages. Let's look at advantages. Advantages of accounting rate of return. Advantages. Advantages of accounting rate of return. Advantages of accounting rate of return. Number one, third examiner, that accounting rate of return is so simple and easy to understand because it uses what? Accounting profits. So it uses accounting profits. And accounting profit is so common. So common to determine. So it's easy and simple to use and to understand because it uses accounting profit. So that is, it uses the accounting profit which is easy to be determined at examiner that determine. Number two, it's so simple and easy to understand. Simple. Simplicity. So basically, that is that simple to and easy to calculate. So simple and easy to calculate. Simple and what? Easy to calculate. And then easy to understand. Fairly easy to understand. Yeah. Why? It's easy to understand because it uses concepts that are familiar to businesses or business managers, such as profit and capital employed. Okay. So that's that. Let's move on to the disadvantages. It has a lot of challenge. Number one, the first challenge, disadvantages of payback, sorry, of accounting rate of return. Disadvantages. Number one, it is based on accounting profits, which is subject to what? Manipulation due to subjective accounting policies. So due to subjective accounting policy, the accounting profit is subject to what? Manipulation. That is all. So it's based on accounting profits, which is easy to be manipulated or prone to manipulations due to subjective accounting policy. That is all. Now, challenge number two. accounting profits are unreliable measure. They are what? Unreliable measure. Because it can be changed, or it can change the annual profits and the average investment. Yeah. Both of them might be changed by altering the depreciation. Slight changes in the depreciation will change the profits and what that of the average investment. Point number 3, tell the examiner that accounting rate of return ignores the timing of the accounting profit. It ignores what? The timing. So it ignores the time value of money. So it ignores time value of money or accounting profits of money into bracket accounting what profits. In simple quotes, it failed to discount the profit into today's terms. If you are getting a profit of 10,000 next year, probably isn't the same as 10,000 today. So kindly discount it and then move on. Okay, so point number 4. Point number 4. The accounting rate of return is a mere percentage of return. It's a percentage of return relating to the average profit. So it failed to tell us the absolute return. So these returns are expressed in what? Percentages, which does not tell us what the absolute return. So it should tell us not 18%, 31.89%, and so what is the actual return? It failed to tell us. Like, so basically, that is that. So we are done with accounting rate of return. Let me quickly hit on payback and move on. Let me quickly hit on what payback and then move on. So let's see payback period. Payback period. Payback period. Then we end the game. Payback. Payback period. For ICA Ghana, payback drop in November 2019. Question number 5 or 3. That is it. Payback there. Last thing was internal rate of return. May 2020, it was a theory. The steps in investment appraisal. Then the November 2020, it brought a calculation. So take note of this payback period. This one, we are going to use the duration that the project will pay back all the amounts invested to assess the project or to evaluate the project. So the project will be selected based on the duration. Now, payback period simple means the duration. It's just the duration which the project will pay back all amounts invested. So duration that the project will pay, duration that will take the project to pay back, take duration that the project will pay back, all the amount invested. That is all. Okay. How do you calculate the payback period? We'll pick the same question that we saw. We are going to use to calculate the payback period. That is all. So let's quickly go through that one too. There are so many methods. Can you go by this approach and you'll be fine? Using the same question, the same example too. We are going to calculate the payback. Example 2. There are so many examples in the material. And we try them. Example 2. Payback period. Or you have here. Please, payback is cash flow. It does not use accounting profits. Bring the net cash flow here. That examine a net cash flow. Then bring your balance. That is all. So payback uses cash flow. And note, payback you start from year 0, 1, 2, 3 up to year 4. Year 0 means now. Today. That is where you invested the capital. The capital outlay needs to be invested now in year 0. Or make that money available for to make the decisions. Okay. So that is that. Now let's see. So this question, let's go and produce the cash flow. Now, let's get the amount invested. The total amount invested is the initial value plus the working capital. Take note. I will explain working capital into detail when I hit MPV. I'm not explaining it here. Good. So add your working capital to initial capital. Let's go to this question. The one we just solved. The initial outlay is 140, working capital is 20, so that will give us 160,000. Okay, so I'll put the 160,000 here in brackets. So put it in bracket. Why? Because it's an outflow. Outflow means we are going to pay. And when I'm making a payment, what do? You subtract, you put in brackets. That's all. As year 0, the balance is still 160. How long will it take this project to pay back? Let's get the cash flows first. Year 0 up to the last year. But they are 90, 56,250, and 90 again. Yes. Now the last year is 25,000. Take note. Last year, kindly make sure that you add the following. If it's a cash flow, please and please again. The last year, it must, the last year cash flow, please add the scrap value to it, add the working capital back. I will explain it at the MPV. If I explain it here, I'm just worrying myself. MPV, look at it in detail. Okay, so cash flow, that year's cash flow. So year 4, if it is the final, we check the final year. Don't forget, take that cash flow, add the scrap value, add the working capital to it, and then you are done. In this question, the last year's cash flow is 25,000. Let's confirm that 25. So I'll add the salary of 5,000, which is 30, and again I'll add the working capital, which is 20. So I'll get 50,000. So there's 50,000, which includes the cash flow itself is 25,000 plus that value of 5,000 plus working capital of what? 20,000. So this how come we got 50. And let's start again. Payback simple means how long will it take you to recoup your investment? Whatever you've invested, how long will it take you? Year one. Year zero, you've invested 160,000. Year one, the project gave you 90,000. So that's how much to recoup. The cash flow for year two is 48, not 56,250. So it's 48,000. So let me finish and make it work. 48,000. Okay. Now let's start again. You have invested 160,000 for an investment plan. After the first year, they've given you 90,000. How much left for you to recoup? We'll take it from it. Let me what? Let me 70,000. I know the first year. So then the time let me what? So put the 70,000 in bracket. Then at the end of year two, you recoup 48. So probably left with what? 22,000, right? Okay. Now you move on. At the end of year three, you had 90. So you could what? Oh, put dash here. Don't continue. So the rest, you leave it like that. You are done. Then you calculate the payback period. Let's go and calculate the payback period. Let's calculate it here. Its duration. It can be in years, months, days, weeks, and many more. So first, we have it in three forms. I'll go through all of them with you. The first one is all in years. If I want the duration can be in months, can be in days, can be years and months, years and days, years and weeks, so many. So I want all in what? Years. If all years, how do I get it? That is in years. So first, the payback will be payback period is equal to. Where do you get a zero? We have a zero here, right? And the payback means by full 2 years plus. Now, what's here careful? This 22, we exhausted in what? Year 3. By year 3, we earn 90,000. So we cannot say that the project will pay back exactly 3 years. No. For 3 years, year 3, we earn more than the 22. So we just have to tell the examiner that it will be 22 out of what? 90. What we pick here? Because here, year 2, 11, 22. If you pick the entire 22 from year 3's own, that becomes 22,000 all over 90,000. That is all. Then this answer becomes what? Yes. You solve this. So 22 divided by 90, that should give us something like 2.44, right? So 0.244. So therefore, adding everything together, you get 2.244 years. That is a payback period. That is so this one is in what? Years, or in years. Now let's move on to situation where it will be years and what? Months. Okay, let's go to years and months. Look at them one after the other. So let's see if it is years and then months. So number 2, years and what? Month. Now if it's years and month, don't worry. just maintain your position. So 2 years versus, then you multiply this ratio by what? 12. So they can get a years and a month. So in that situation, you have what you call 2 years and something months. So just multiply the fraction by 12. So fraction by 12, this times 12. That's 2.9, so roughly 3 months. So 3 months. So 2 years and 3 months. Okay. Now I want it in years and days. Now I need you to do it for me. Years and days is your turn. So can you let me have that one? Years and what? Days. Can you take note that this is not plus, it's minus comma or and. So in that situation, please put it and, because if you say plus, it will add. So and, okay, so 2 years and this month and something months. Good. So it will be 22,000. So 2 years, you know it's already to be fixed. Now I don't touch it. Okay, so 22,000 divided by 90,000, 1, 2, 3 times 12. Get 2.93. So that means 2.93 months. And 2.93 months is equal to what? 3 months. So 2 years and 3 months. And that's the final answer. Now you are doing years and days, or all in months, or all in days. So try that one for me. Yes. Whilst we move on with the acceptance criteria. Now I have to provide this. Let's look at the acceptance criteria. On what basis do you accept the project if you're using payback period? We have for a single project and multi-project. I didn't do that for the account rate of return, multi-project. I think I will explain that and then you'll be fine. Multi-project simple means here you have a lot of projects that you are evaluating, not only one. So acceptance criteria. Acceptance criteria. Number one, I will talk about single projects. The project is only one. Then third examiner, accept the project that can pay back. Accept the project that can pay back. Agree. Project that can do what? Pay back. Accept project that can pay back. That's for a single. If it is for multi, number two, multi-project, meaning multiple projects. The project is not just 1, 2, or 3. Then accept the project that would want least payback period, because you have to pay back in the shortest possible of time. That is all. If the project cannot pay back, don't accept it. That's all. That means some of these figures will still be negative. The closing balance will still be negative. That is the meaning. Now let me chip in this. Accounting rate of return to also have what? Multi-project. That one too, you select the one with the highest account rate of return at the same time, which is more than what the target or the expected or the receive. That is all. Good. Now we are done. Let's go to advantages and disadvantages of payback period. Great. So if you compute it in years and days, you get 2 years and 89 days. That is all. Okay. Now let's look at the advantages and disadvantages of payback period. The good news about payback. Good news about payback. Good news number one. Good news number one. Simple payback. Simple to use and to calculate and to understand. It's simple and easy to calculate and understand. That's the first one. The good news, number two, I don't want to write on the board because I'll use it to explain the disadvantages. I don't know how to put on the board. Number two, it uses cash flow but not profits, which are not what subject to manipulations. Yes, it's very difficult to manipulate cash because you have 1,000 Ghana cedis with you. Anywhere you go within Ghana, it's 2,000 cedis. Within Ghana, it's 2,000 cedis. But if I give you transaction, as you calculate the profit, you can use a different method to estimate the depreciation, and your profit will be different from someone's profit. So profit is easy to be manipulated than cash. That is all. Cash, count it. If you count it and it's 1,000, that's all. Anybody that can must get 1,000. Then let's go to method 3. Sorry, the advantage number 3. Payback can be used to eliminate projects that will take too long to pay back. Wow. So payback helps you do what? Eliminate projects that takes too long to pay back. That is all. Now let's go to the challenges that we have. The challenges of the payback period. And that is why I'm not doing about it. Disadvantages. Number 1, as I mentioned, I've been about. There's a bigger challenge that we have. Payback ignores the cash flows after the payback period. It ignores what? The cash flows after what? The payback period. Have you seen that there's 50,000 at the end of year 4? We even worried ourselves to do the calculation. We didn't even touch it. Yeah, it was 90. We picked only 22. We did not even touch the remainder. So that's a challenge that we have. How can you assess the project and consider only some of the cash flow and leave the rest? The rest, take them into consideration. Okay. So payback ignores the cash flow after the payback period, or it does not consider all the cash flows. That's a major challenge. Okay, then you tell the examiner now. Then challenge number 2, payback period does not discount the cash flow. So it does not consider the time value of money. Point 2, it does not consider the time value of money. That's payback period. Don't forget that there's a difference between payback and what? Adjusted payback period. So point number 3. Okay. So the third challenge. Now, payback period, the third challenge is that it does not give the absolute value of return. This is a challenge for both payback and the amount of return. It does not give what? Absolute value. Absolute value of the return. Absolute value of the return. Payback does not give absolute value of return. And that's the challenge that we have. It will just tell you, oh, 2 years the project will pay back, but the return that you get will not tell you. Okay. So, final notes, probably will end here. This is how far the good Lord will bring us. So now note, we will continue again. Good. Please and please again, can you join us when you're solving the question? And you can go through and go further. Before I forgot, let me give a trial. Example 3 is your own. Example 3. So example 3 from the material. Yeah, it's payback and account rate of return. So you're solving this example. Example 3 in the material is your own. This one, I need a solution. I'm begging you. All of them, I don't receive solution. Somewhere. Okay. Then, second, kindly continue with the analysis. So, all what you have to do is this. Kindly visit our page, the YouTube page, and move through to the management accounting section. Tap on it, then go down, look for capital budgeting, investment appraisal. Here it is. Go through it, tap on it. All the videos will come. Can you finish it before our next meeting? Good. So, that is that. So can you do that for us? And then you can also subscribe if you have not done that. You can also use the arrangement I did and I uploaded on the page. All of them will work equally. So thank you very much. I'll see you when I see you. See you again in the next class.